Welcome back to Wall Street Podcast. Today, we're taking a deep dive into a recent research report from UBS Securities Asia Limited. It was published July 10th, 2025. This is their first read report, and it gives us a preview of JD.com's second quarter 2025 performance. Specifically, it factors in those significant new investments in food delivery and, the broader implications. Our mission, as always, is to quickly pull out the most important nuggets of knowledge for you, the well-informed investor trying to navigate China's e-commerce landscape. Okay, let's unpack this. UBS highlights JD's stepped-up investments in food delivery. What's the scale we're talking about here, and what are the immediate financial implications for Q2?
Well, the scale is really what's crucial to understand. For Q2 2025, UBS estimates JD's food delivery investment at a substantial RMB 10 billion.
10 billion. Okay.
Yeah, and to give you some context, that's comparable to what Alibaba is spending.
Right.
And this isn't just, a rough number. It's based on an estimated average daily order volume of around 12 to 13 million. And currently, each order is running at a unit economics loss of about RMB 8 to 9.
Ouch, okay.
Looking ahead, they project this investment ramps up to RMB 14 billion in Q3, then dips slightly to RMB 30 million in Q4. So for the full year 2025, the total estimate is RMB 35 billion.
35 billion, that's a huge burn rate.
It is, though worth noting, still less than Alibaba's estimated RMB 50 billion for the year.
So with that kind of capital going out the door, is this just a market share grab, a blind spend, or does UBS see a clear ROI focus?
That's a critical question, and UBS suggests JD is actually trying to remain ROI focused.
Okay.
It's a balancing act. They're pushing for stronger volume into Q3, which is seasonally stronger anyway, but also actively working on optimizing those unit economics. Industry checks apparently indicate they're getting smarter, modifying and targeting customer subsidies more precisely.
Makes sense.
But the really critical point here isn't just the spend itself, it's the early positive indicators UBS is flagging.
Like what?
We're seeing strong traffic growth. And importantly, it's coming from categories like beverages, which are appealing particularly to female users and also users in lower-tier cities.
Interesting demographics.
Exactly. And that directly enhances JD's primary user base. That's where the potential long-term value really lies.
You mentioned enhancing the primary user base. That flows right into user acquisition, doesn't it? What does the report actually say about JD's recent DAU, daily active users, and MAU, monthly active users, especially compared to rivals? That's often the pulse of future growth.
Absolutely. And if you connect this to the bigger picture, the report, it cites Quest mobile data, says JD actually saw the most rapid growth in both DAU and MAU among the major Chinese e-commerce players in Q2.
The most rapid, faster than Taobao and PD.
Significantly outperformed them, according to this data.
That's quite something.
It is. And for investors, UBS believes this should create a strong foundation for, future cross-selling opportunities, between this new food delivery arm and their core e-commerce business.
Bringing new people into the fold.
Precisely. Expanding the JD ecosystem.
Okay, let's shift gears slightly. Beyond this big food delivery push, JD Retail is their established core. How did it perform in Q2? Especially with the broader macro environment perhaps being a bit challenging?
JD Retail showed sustained resilience. It's really quite impressive, a testament to their operational strength.
How resilient are we talking?
Group revenue remains solid. It was up 14% year over year in Q2.
14%, okay.
And that significantly outpaced China's overall online physical goods retail sales growth, which was only about 7% for April and May.
So they're gaining share within online retail.
Seems like it. Electronics and home appliances kept up strong momentum, about 15% year-over-year growth. That was helped by having a full quarter of those trade-in subsidies, plus new AI product launches driving interest.
Right, the AI features are everywhere now.
And general merchandise also saw solid growth, again around 15% year-over-year. UBS attributes that to deeper SKU variety and just stronger consumer mindshare.
Okay, solid performance on the top line for the core. But what about the margins? Specifically the high-volume marketplace and advertising revenue. That's often the profit engine.
That's a key segment, absolutely. And it's performing well, too, with the, more vibrant traffic and ecosystem, partly fueled by these new initiatives.
Like food delivery bringing eyeballs.
Exactly. Their high-margin marketplace and advertising revenue are expected to sustain growth at around 16% year-over-year in Q2.
16%, nice.
What's perhaps even more impressive, though, is the margin itself. despite having a high base to compare against and despite increased promotional spending.
Which you'd expect with competition.
Right. JD Retail's margin is forecast to remain steady, stable at 3.9% in Q2.
How are they managing that?
UBS points to sustained efficiency improvements, better procurement, more efficient fulfillment. These operational gains are basically offsetting those higher promotional costs.
Some more operations.
It seems so. The adjusted operating profit for JD Retail alone is projected at RMB 11.6 billion, which is up nearly 15% year over year.
So the core business is actually quite healthy and growing its profit.
Yes, which means it's robust enough, for now at least, to cushion a significant part of the blow from these new ventures.
Okay, so let's bring it all together. You've got this strong core retail business, but this massive drain from the food delivery investment. What does that do to the company's overall bottom line? And how has UBS adjusted its outlook and, crucially, its price target?
Yeah, this is where you see the combined impact hitting hard. That significant food delivery investment, even if strategic long-term, has a direct and, well, substantial impact on overall profitability right now. The group's adjusted net profit for Q2 2025 is estimated at just RMB 5.6 billion.
Okay.
That's a sharp drop, down 61% year over year, and it's largely because you have to factor in that RMB 10 billion food delivery investment loss for the quarter.
61% down, that's a big hit.
It is, and consequently, UBS has had to cut its earnings per share forecast for 2025 through 2027 pretty significantly by 10 to 35%. They now estimate JD's overall adjusted net profit for the full year 2025 will dip to around RMB 25 billion. That represents a 47% year-over-year decline.
Wow, nearly halved year over year. That's a major revision.
Yeah.
Yet UBS keeps a buy rating and says they see limited downside.
Yeah.
How do they square that circle, that near-term profit pain, with a positive recommendation? What's the thinking on valuation?
This is where the valuation perspective is key. So based on these revised lower estimates, UBS has lowered their 12-month price target. It goes down to US $50 or HK $195 from US $58 previously.
Okay, a cut, but still well above the current price.
Exactly. Their buy rating, despite those earnings cuts, suggests they think the market has already largely priced in this food delivery investment impact. The stock was trading around US $31.60 when the report came out.
So the bad news is already baked in, potentially.
That seems to be their view. They note JD is trading at about 13 times their lowered 2025 earnings estimate. Or perhaps more tellingly, an undemanding 8 times core PE.
8 times core PE. What does that mean exactly?
That core PE essentially strips out the losses from the new food delivery venture. It's looking at the valuation of the established, profitable retail and logistics business, and on that basis, it looks quite cheap.
I see. So they're valuing the parts separately.
Right. They use a sum of the parts methodology, SOTP. They value retail, logistics, the new ventures like food delivery, maybe other assets, separately and add them up. This implies they see value beyond just the headline consolidated profit number right now.
Okay, that makes sense. But every investment carries risk. What are the key downside risks and, maybe more importantly, the monitoring points UBS flagged for investors to keep an eye on with JD?
Yeah, they definitely highlight risks. Key ones are low visibility on profitability, especially with this food delivery battle, intensifying competition, obviously, and the long-term returns on their huge investments in fulfillment infrastructure, will they pay off?
And regulation, always a factor in China.
Absolutely.
Yeah.
Regulatory changes are a constant dynamic factor you have to watch. But for investors trying to track progress, UBS suggests focusing on 4 key things.
Yeah, what are they?
First, and arguably most critical, the timing of when this food delivery competition might peak. When does the crazy spending phase potentially end?
That would be a major signal.
Huge. Second, watch for any actual synergies materializing between food delivery and JD Retail. Is that cross-selling happening? Is the user growth translating?
Proof points needed.
Exactly. Third, keep a close eye on JD Retail's margin progression. Is that core strength holding up under pressure?
Maintaining that 3.9% or improving it.
Right. And fourth, look for potential upside in shareholder returns. Once things stabilize, could we see more buybacks or dividends?
So watch the competition peak, look for synergies, track core margins, and eye shareholder returns. Got it. Okay, that wraps up our deep dive into UBS's Q2 2025 preview for JD.com. It really is a complex picture, isn't it? You've got this aggressive, costly investment in food delivery hitting profits hard in the near term. But at the same time, it seems to be driving significant user growth and offers potential synergies down the road. And all this is happening while their core JD Retail business shows, frankly, remarkable resilience. We've seen how expert analysis like this UBS report really unpacks these different layers, giving you those critical insights to stay well informed.
And remember, knowledge like this is most valuable when you really understand it and think about how to apply it. Consider how these kinds of investment strategies might play out, not just for JD, but across the broader Chinese e-commerce landscape. What do those early user growth indicators truly mean for future market share? Can JD really maintain that operational efficiency in its core business while fighting this new, very expensive battle? Definitely keep an eye on those profitability metrics, the competitive dynamics, and those synergy proof points as this whole story continues to unfold.